The Magnificent Seven have fueled the U.S. stock market's rise to record highs. But charts like this one are starting to freak out some investors. The 10 largest stocks in the S&P 500 now make up a whopping 1/3 of its total market cap. And believe it or not, that's even higher than it was during the dot-com bubble. And we all know how that turned out. So is this a screaming sign that trouble is ahead? And if so, what can you do about it? Well, we're about to find out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, back in the saddle. Happy to be back after a bout of pneumonia. And I'll admit though, I'm a little rattled by the overconcentration in the S&P 500 index myself. I'm a big believer in diversification and there just seems to be less of it right now. But thankfully, there are some investment products called equal weight ETFs that are one way to help get some of that diversification back, and we're going to learn all about them today. Joining us is Bipan Rai. He's the head of ETF and Alternatives Strategy at BMO Global Asset Management. Bipan, it's great to have you back on the show with us. Thanks for taking the time.
Thank you for having me, Rob.
Of course, we have this growing concern about a potential overvaluation in the S&P 500. The idea that these big tech stocks that have done so well for so long, what go up must come down eventually, right? What's your take on this idea that we're due for a correction based on what you're seeing in the market?
It's a good question. I mean, corrections come in different flavors, right? So we could have a fairly pronounced one like we did last year during Liberation Day, and that's triggered by a particular shock. We can have a more gradual one that extends over a longer period of time, which is something that we had after the last tech bubble that we had over a quarter of a century ago. So, whether or not we're on the cusp of another correction, it feels like we're a lot closer to it than, say, we were maybe a year or two ago. And again, it really speaks to the degree by which evaluation is a concern right now. But as we talk to investors and clients about, is that valuation on its own is not a reason for a correction. You do need a secondary catalyst potentially to trigger that. And oftentimes, it's been too tight monetary policy from the Federal Reserve and the like.
There's that could be one thing. I mean, now we have like a fresh war breaking out in the Middle East and stuff like that. Are these typically the catalysts that might trigger that kind of correction? So,
I mean, if we're talking about a geopolitical conflict, believe it or not, no. Actually, it doesn't necessarily portend to, say, an imminent recession in the United States. Now, it could mean something nefarious insofar as energy prices go. And certainly the 1970s experience does tell us that when oil prices go too high, it can be advantageous for an economy and, of course, lead to a curtailed degree of household spending and the like. But certainly in the decades since, we haven't seen anything remotely approaching that type of move when it comes to geopolitics. And so far, even with this conflict, and I'm not making a forecast here, but, the movement higher in oil and natural gas prices has been somewhat measured as opposed to being something alarmist.
Yeah, I suppose the market is still in a little bit of a wait and see kind of mode here. That said, we're seeing also some allusions to the top tech stocks today versus the dot-com era tech stocks. Do you think that's a fair comparison based on valuation and kind of the underlying companies that we're dealing with?
I think there's a fair bit of difference between what we're dealing with now relative to back then. I mean, back then we had, a lot of equity financing going on. Really, it was about, issuing more shares and relying heavily on that new form of financing to really pursue whatever opportunities there were back then. Nowadays, I mean, this is really being driven by a lot of firms that have fortress-type balance sheets, have relied heavily on endogenous cash flows over the last several years, and now are tapping external debt financing more and more to drive some of that extra spending. So at this point, I mean, I think it's a bit different than what we saw 25 years ago. I'm not saying it's not a bubble, right? But I do think the characterization of what we saw 25 years ago does not necessarily need to apply to today. And, I guess the easiest way for me to sort of spell out the theme now and how we've migrated from over the past couple of years to where we're going is that instead of this being a beta story where, like, if all these companies are spending money, oh, you know what, this is the AI trade, you got to play the beta story. This is going to be a story where there are winners and losers now. And a lot of that is going to depend on existing capital structure and whether or not their own business models are potentially vulnerable to disruption.
Yeah. And I mean, of course, we don't know exactly what's going to come with AI. Certainly there's a lot still to be written about that. But I think the interesting, comforting thing, if you will, is when I look at the price to earnings valuation today versus some of the top guys back then, It is a pretty big gap. So I mean, it doesn't seem like we're on like the immediate precipice at least, but of course, like, you know, there are concerns in the market there. We're going to get into some of those. One of them being this idea of overvaluation. What could that mean if the other shoe does drop? Does it drag everybody down with it? Yep. We're going to get into that, and of course, like I teased earlier, how equal weight ETFs can help protect a portfolio in an overvalued and overconcentrated market. We're going to dig into all the mechanics behind that, see if there's a way that investors can kind of take the edge off of some of that risk. For those in our audience, if you want to get in on this conversation with us, we'd love to hear from you. Make sure you submit your questions to us. If you're watching on Webworker, you can use the chat box to send your questions to us. On our broadcast platform, it's the questions and comments box on the right side of your screen. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to our broadcast platform, and that's where you can ask your question. So, Bipan, we were talking a little bit about the overconcentration in the index, the S&P 500 specifically. How big of a concern is overconcentration in its own right?
Oh, it's a big concern, for sure. Because, I mean, if we're talking about concentration risk over the past couple of years, it's worked out for the investor, right? I mean, there's a couple of really strong stocks driving the entire index. I mean, fine. But then we also have to take into consideration the other side of things, right? So if we're talking about concentration driving returns, there's also concentration driving risk to the downside as well. So, you know, let's say we get a decent round of earnings from some of these companies. If, you know, even if you miss expectations by a degree, or if you say miss entirely, I mean, that is going to mean that there's a lot more downside potentially for the broader index relative to what we've seen in the past. So the way I kind of characterize it, and I think this is pretty nifty, is that it's not so much a broad diversified index anymore. It's a couple of stocks with an index attached to it, right? So again, that works in favor of returns, but it also works in favor of potentially more risks. So I should say not in favor, but you understand what I mean. There's a lot more two-way risk to where the index goes if things are more concentrated.
Yeah, I mean, it's interesting to hear you say that, because I have seen some studies that suggest overconcentration in itself does not necessarily predict how is the market going to do. Right. So is this a risk that is one among many, or is it like, I guess, one of the driving risks, let's say, behind like, you know, a potential correction, let's say?
Yeah, I mean, so think about it this way, and this is something that you can actually verify empirically if you were to look at the starting point evaluations in a given year, going back several decades, and project or look at what happened in terms of forward 12-month returns afterwards, right? So say we started January, the PE ratio is anywhere between 20 to 25. Well, it turns out the forward 12-month earnings is around 4 to 5%, which is typically below the long-term average, right? So it tells you that valuations, you know, as far as what history tells us, is going to work against you. Typically, right, if we're at these sort of levels. And then, you know, again, you pair that with a heavy degree of concentration risk. I mean, there's two significant headwinds there potentially for investors to consider if they're looking at the broader index, the broader market cap index, I should say.
Another like sort of interesting wrinkle I've heard to all this is that the companies that dominate the S&P 500 today, like, they deserve to be valued higher. Like, structurally speaking, like the types of businesses these are and this global scalability, you can't like sort of judge them by past historical PE ratios. Is that like a fair observation?
I think so, yes. I mean, if you were to look at the composition of the S&P 500 and how that's changed over the past several decades, I mean, certainly you can make a strong case for the fact that, look, you know what, a lot of the firms over the past couple of decades have been dominated by these tech names with fortress balance sheets that don't necessarily need to rely on a heavy degree of assets and relying on debt financing to fund those assets. I mean, certainly you can ascribe a higher degree of valuation to them, and we shouldn't really treat that as something consistent with what we would have seen in, say, the 70s, 80s, and 90s and the like. The other angle to remember, too, is that if we're thinking about things from a macroeconomic lens, and that's certainly the area and the environment that I'm most familiar with, you know, since the financial crisis of 2008, there's been an inordinate amount of liquidity pumped into the system. So what that means is that at any given point, investors have a good feeling that, you know, there's the proximity towards liquidity and the central banks actually providing that via larger balance sheets and the like. That, believe it or not, does provide an impulse towards the equity market. It's not direct, it's indirect, but we know it's there. Right? And that simply wasn't the case before the financial crisis. There was a theoretical upper limit on what the Federal Reserve could do with its balance sheet. And we didn't see as much, let's say, fiscal loosening as we have seen in the United States over the past couple of years. Not since World War II, I would say.
Okay, so that kind of serves as maybe like a floor of some kind, I guess.
It makes the comparison between where we are today versus, say, the 70s, 80s, 90s, and even the early 2000s. I mean, it does provide a degree of clarification or an asterisk that we do need to take into account.
Okay. And you had sort of mentioned it a little bit there earlier, AI bubble. This is something that like people are very concerned about. Based on what you're seeing in the market, do you think that we're in an AI bubble? Because this seems to be like the singular risk that a lot of people point to and say, like, if something's going to make the other shoe drop, like this is it.
Right. So I have a hard time characterizing it as a bubble, right? We're seeing a heavy degree of spending, yes. Now, with respect to that spending, no one's quite clear on how to make sure that the long-term profitability is there and clear to everybody so that, we can actually quantify the degree of spend and be reasonably certain that this is going to lead to a long-term degree of profitability, not just for the company, but actually be beneficial for the economy writ large as well. So that's, I think, the trouble for a lot of investors, right? So, this recent round of earnings that we had from the tech space, I mean, they were all solid numbers. We did see a significant amount of earnings growth. There was also, a significant amount of planned capital expenditures, but we've migrated away from this environment where it's just about spend, spend, spend. We don't care. Well, the fact that you're spending is actually a good thing for not just the AI space, for the broader economy. It tells us that productivity over the medium to long term will increase. But we've migrated towards an environment where, okay, you're spending a lot, but what is the actual link towards profitability, right? So it's not just, we're not treating it without risk now. We see the fact that risks are starting to be amplified, and investors are putting a bit more of a premium there. And there's if you talk to a lot of the hyperscalers, the companies or the CEOs of the hyperscaling companies, a lot of these expenditures are planned years in advance. Well, what if the situation changes between now and then, right? That you're committed to a lot of spending, you finance that now externally via debt, but what if there's a more efficient way of compute? What if regulations change across borders, right? These are risks that are coming into sharper relief now, that we know that the degree of expenditures is quite high, and the fact that they're being relied on by issuing debt.
I know we're still like pretty early in the story, but there was a really interesting study, or survey rather, of CEOs saying that 50% of them found no tangible benefit from the AI investments they've made thus far.
Right.
Is that not a warning sign, or is it just too early in the story to make that determination?
I think it's the latter as opposed to the former. I mean, I certainly, as part of our own research process, we do not rely on AI to write our research, but we do incorporate it as part of our own research and investing process, right? So we do it more from an infrastructure point of view, and it has made us a lot more productive relative to what we used to. So instead of reading, copious amounts of research reports, now, we will read them, we'll skim them, and then we'll filter them through an LLM and get the appropriate and salient bullet points that we need to take away. It helps us with our own investment process. And I suspect that a lot of other investors are doing the same thing. And I think it's a great thing from that lens. Now, in terms of has it actually driven more productivity over the medium to long term, I mean, I would take that on a company by company basis. But it's hard for me to not see the productivity enhancement that this is going to provide over the medium to long term. The key question, though, is whether or not it's going to be disruptive to the labor market. And there seems to be a fair degree of pros and cons to that, or at least people that are in either camp.
Yeah, certainly lots of concern about if jobs writ large are replaced, like what does that mean for companies' underlying business and stuff like that.
Right, and it's the speed of displacement too, right? I mean, I'm sure everybody's heard about, anytime we've had this, this wave of technological disruption, it leads to new job creation, jobs that we haven't even thought about. I mean, certainly, if you asked me 20, 25 years ago, I would have no idea what a social media strategist is. But there's a lot of those types of jobs out there. But prior technological disruption happened over an extended period of time. I don't think it was as quick as the incremental gains that we're seeing in the AI space right now. And I think that, justifiably so, has a lot of people concerned.
Yeah, and so on that note, let's say I'm an investor, I'm concerned about overvaluation risk, overconcentration risk in some of these names. What can I do to kind of hedge some of that risk? Equal weights is one of the options being bandied about.
Yep.
Tell us about equal weight ETFs, how they work, and is this a viable tool to deal with some of that overconcentration risk?
Yeah, I mean, there's different ways that we could sort of look at an equal weight index. It can be constructed such that components of the index have all the same degree of allocation. That's traditionally been the way that we see these types of indexes constructed. But it generally means that leadership broadens, so it's not so concentrated, much like it has been over the last couple of years. And that also jives with what we're seeing on the ground as well, right? So the AI story, we're seeing it incorporated more and more outside of, say, tech and communications into other sectors, such as healthcare, such as industrials and materials and the like. And so there's that tailwind, plus plus also the fact that we talked about valuation earlier. And valuation is extremely high for a few sectors. Well, we're still in an environment where the underlying fundamentals remain strong. So instead of, over-investing in those sectors that are already overvalued, we're seeing some of that migrate towards some of those undervalued sectors. And certainly we talked about the fact that valuation now might not be the same as valuation a couple of decades ago. Well, that's the case then. We can make the case that these other sectors, as they continue to adopt these technologies, as they become more productive and efficient, then there's a reasonable case to be made that they're undervalued at these levels, right? So we're seeing some of that play out as well. But again, an equal weight index, ETFs that track equal weight indices, such as the one that we just launched, these are products that help you hedge against that overconcentration and that AI risk.
Mm-hmm. Yeah. One of the curious things I find about the way that equal weight ETFs are structured is that they're basically fighting momentum, right? Because everybody's got to have the same weighting within the index. Mm-hmm. So you're naturally then going to be selling winners when they get a little bit too big, and you're going to be buying losers when they get too small to bring them back up to that weighting.
Right.
Momentum has been an observed factor that is, good, stocks doing well, continue to do well for a time and vice versa. Right. Wouldn't it be bad for returns to pursue a strategy like that where you're fighting momentum?
So it depends on the regime that we're in, right? So that's why, we look at an equal weight index, and there's different ways that you can allocate within the portfolio if you're using a core satellite approach. Our own sort of preference over the medium to long term is to use an equal weight more as a satellite position. Certainly it's defensible to use it as a core position if you think that over the medium to long term, equal weight will outperform the market cap. But for exactly what you pointed out, there'll be some instances, some regimes where concentration, yes, things are becoming more and more concentration, but the momentum is too hard to fight, right? But I don't think we're in one of those environments right now. In fact, I dare say that we'll be in this period where we should see broadening leadership play out for several quarters ahead of us, right? So if that's the case, then this would be the point, given the valuation, given the concentration risk, we kind of want to migrate away from, say, over-allocating towards a broad market cap weighted index towards something that's more equal weight. Yeah.
So now is a good time for those who are concerned
Absolutely.
about overweighting. Okay.
Absolutely.
Interesting. And then the other thing too that I think a lot of investors are kind of concerned about with equal weights is this idea that the equal weight index, I like the idea maybe of broadening up my exposure, but I don't want to, it's hard to watch the market cap one do so well.
Right.
So how could I work an equal weight ETF into my portfolio where I'm still maintaining exposure to the stocks that have done really well, but I'm just taking a bit of the edge off? Is there a rule of thumb that they could use to do that?
Sure. I wouldn't call it a rule of thumb. I can give our audience sort of an understanding of how we approach these sorts of decisions. So, obviously within the equity sleeve of our balanced portfolio, there's an allocation towards the S&P 500, let's say. And let's say we benchmark that to 20%. I'm not saying we do, but let's say that 20% of our equity sleeve is made up of an ETF that tracks the market cap weighted S&P 500. So if we're of the view, let's say that momentum should take a step back as a factor, that leadership should broaden out, and the index is too concentrated, well then instead of 20%, maybe we dial that back to something like a 15% and allocate a bit more to something like an equal weight strategy, right? So then we're playing with conviction a little bit, right? So instead of 15%, if we're really, really certain that over the next several quarters that an equal weight gauge will outperform, then maybe we dial that 15% back to a 10%. Right, and allocate the other 10% towards an equal weight strategy, right? Mm-hmm. So it's kind of like understanding, you're not replacing the entire position of with an equal weight as opposed to a market cap weight, unless you're really gung-ho about the idea that equal weight is going to outperform for an extended period of time. But it's really about tinkering with the weights and what makes sense to you. And then, as we always say, constantly reassessing and staying on top of what's going on. Right.
And then the other thing too about this is that some investors, obviously they're concerned about the volatility that you can have when there's a lot of overconcentration in the market and those few names dominate things.
Yep.
Is an equal weight ETF more or less volatile, generally speaking, than like a market cap weight one? I know it's kind of hard to generalize, but is there anything that you could point to?
Well, here's what I'll say, right? And it really speaks to what you just said. The fact that we're in a very, very concentrated environment right now, or we have been for the last couple of years. Remember that when we get to these concentrated levels, there's a greater degree of 2A risk. In fact, not even too at risk. There's probably more risk towards the downside, given the fact that we're relying on, a handful of names basically to drive the entire index. So, case in point, we did get earnings from Microsoft, we got earnings from Nvidia, we got earnings from Alphabet and Amazon recently that were fairly healthy. Now, that's still the case, but we're still in this treading water insofar as the S&P 500 is concerned. Right, so that tells me that the good news or the optimism with these names feels saturated at this point. Right, so I would say in this sort of environment that if you take an equal weight approach, there's probably a lot less volatility potential relative to the market cap names. So the implied volatility for pricing an option is probably lower for equal weights. I mean, I'd have to go back to my Bloomberg and see that on my own. But to me, there's a greater degree of risk. Ergo volatility with the market cap names at this point relative to equal weight, I would say.
What about in more like normal market conditions? Do you think it's like quote unquote riskier to be essentially overexposed to a lot more smaller stocks, or is it more risky to be exposed to a few larger ones that are leading the market?
Over the long term, I would say it's probably more riskier for the former. Right, so you do have, greater allocation towards small and mid caps, and to get really excited about those names, for me as a macro guy, I need to know where we are in the economic cycle, right? So for recovering, if the worst part of an economic downturn is behind us, usually you'll see the leadership driven really by small and mid caps. As we get further and further in the economic cycle, that tends to migrate away from small and mid caps towards large caps. And for, if we want to sort of measure the amount of time that we spend in each of those phases of the expansion over the past several decades, I mean, there's obviously more time we spend in the middle to the mature phase of an expansion. And so for me, answering that question then would be that, you want to have more allocation towards large caps relative to small caps over the medium to long term.
Okay, so that's good food for thought for folks, because there's a little bit of a market timing exercise.
Absolutely,
of course. But that's good perspective to keep in mind. The other thing too that is always top of mind for ETF investors, fees.
Yep.
Again, of course, all these products are very different. They can vary, but generally speaking, does an equal weight ETF have roughly the same MER as like a market cap weighted one would?
I mean, generally, it should. I'd have to double check what the MER is for the ZEQL, which we just launched recently. But again, I mean, it really depends on the ETF issuer and the provider. Ours, do we pause it or I don't like? I mean, it's just it's generally they tend to be fairly consistent. So they're not, because of the fact that they're well diversified, and for a lot of investors, they tend to represent the core. You don't tend to get as expensive as if you're relying on derivatives or something else for the underlying.
Right. So it's not like a super complicated, derivatives-based strategy or something like that.
It's
kind
not
of like a recalibration thing.
Exactly. And again, you're tracking an underlying index, so it makes it a passive instrument, which traditionally is costs a lot less than something that's more active.
Right. Okay. So we're talking in the same kind of ballpark here. Okay. That's good to know. One last one, if I could ask you, because we're talking about index, obviously the S&P 500 as an example, but there are also a lot of sector equal weight ETFs out there.
Yes.
And BMO, I know you guys are a provider of them, of course. What would be the case for having a equal weight sector ETF? Is it the same underlying logic as you would use for an index, or is there different mechanics at play?
I mean, it's the same underlying logic, I would say, with probably greater inherent risk there, because then you're basically betting on one particular sector relative to a broader, diverse array of sectors, right? So, if you had a fairly strong conviction, let's say that real estate or materials were undervalued in this environment, and the fact that maybe that there was a fair degree of concentration risk in those two sectors, I mean, that would be an environment where you'd want to consider something like an equal weight sector. Our own preference really is, if we're looking at things from a diversified point of view, that we tend to look at a broader index that's equal weight as opposed to an individual sector. But again, really depends on your conviction at a particular point.
Right, okay. Yeah. Appreciate you filling us in on equal weights. It's an interesting, very topical thing today right now with all the overvaluation and concentration concerns, So appreciate you giving perspective on that, because I think this is a product that a lot of people may have heard about, but they don't actually know that much about. So I appreciate the details there. Before we continue, I have a quick question for our viewers. Did you learn something from this conversation? Are you enjoying the show so far? Then make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. We got a ton of content on there designed to help level up your investing knowledge. And of course, we have some sneak peeks at upcoming episodes of this show and others as well. So make sure you follow us. If you're not, QR codes are on the screen. Give them a scan. Okay, Bipan, I want to get to another segment related to our sort of conversation about overvalued markets, overconcentrated markets and stuff like that. A segment we like to call hot takes. Okay, we've heard some interesting perspectives in the past. I want to bounce some of these ideas off of you, see if you agree or disagree. Let's get to our first one. And our first one is from a 22-year-old investor named Matt Schoss, who was on our show recently. He said he thinks we're in an AI bubble, but he's not particularly worried about it. Let's hear his logic.
It's not something that I really deeply, fret over, because the reality is, the way I see things is that if the bubble does pop, or when it does pop, we don't know how much it's going to be, but I'm also okay with being exposed to all those companies, because AI isn't going anywhere. Those companies are still going to, I think, perform in the future, and I don't see a world where those companies are non-existent. I don't see it.
Okay, so that's his logic, and I want to ask you: is that sound logic? Maybe for someone who's like a long-term investor, he's obviously not looking to sell anytime soon.
Right.
But the idea that look, AI is going to be a thing, and so therefore, like the companies that are at the forefront of it right now, like I'll just take my lumps if they go down in the medium term. But like it's not a big deal. Is that logic sound to you, or does it require a little bit more nuance?
I think it requires a little bit more nuance, right? So. And I hate making the comparison to 25 years ago, but there are companies that are around now that were there 25 years ago during the tech bubble that made certain decisions that made them going concerns over the medium to long term. But there are several other losers that didn't quite make the cut afterwards, right? So it really depends. If we're talking about AI, we're not just describing one particular aspect of it. There's different components of AI that we need to pay attention to. There's companies that focus on the LLMs, the models. There's companies that focus on chips. NVIDIA has a pretty strong moat around it, probably will be around for quite some time. And then there's other ones that focus on the applications and of course, data centers, cloud, the cloud, and all that. And then there's companies that are basically involved in each and every one of those processes. So something like an Alphabet. It really behooves you to do your research to understand the fact that, look, you might not be worried about AI. You might not think AI is a bubble at this point, but that doesn't mean that there aren't going to be winners and losers, and some of those losers might not be around over the medium to long term. So again, a little bit more research is required there, a little bit more nuance to what that particular person is thinking, would go a long way in their investment process, I would say. Yeah.
It's interesting too, to make another comparison 25 years ago, the internet, obviously the internet's a thing, internet didn't go anywhere, but anybody using Netscape anymore these days, or any of these things, right? Right. It's not enough to be like an early mover, you have to continue the advantage, and what you pay for a stock too matters as well.
Exactly. I mean, Cisco Systems, I think, only last year recaptured the same valuation that it did, say, 25 years ago. And there's a case in point right there. It's a company that, you could say over the long term wasn't exactly a loser, but it took a long time for that particular stock to recover.
Yeah, 25 years is a long time for any investor. I don't care how long your time horizon is.
Absolutely.
Okay, appreciate your take on that. We got one more for you. This one coming to us from DIY investor Ian Lopuch from the YouTube channel PPC Ian. He says he's added a lot more diversification in recent years, just given all of the things we're seeing in the market right now. Let's hear his rationale.
There wasn't quite, in my opinion at least, the level of risk in the world then that there is now. And so how I have diversified my portfolio is I have bought 44 at this point ETFs and stocks. And the reason I've done that is to really shelter myself from single company risk. Because what I found in 2026 and in recent years is things just happen in our world. And there are risk factors that could possibly cut a single company in half. And so I don't want any single company in my portfolio to have risk that would take away from my goals of reaching financial freedom.
Okay, so Ian clearly, concerned about downside risk, like I think a lot of investors are. I have two questions for you on this one. One, 44 stocks and ETFs. That's a lot. That's a lot.
Yeah.
Is he overdoing it? Do you think? That's one question. And the other question too is this time different in some respect? That's kind of what he's getting at.
Right.
He's saying there's heightened risk right now, and does that require more diversification? What are your takes?
Right. So, I always go back to that famous quote, the only free lunch in this business is diversification. But, diversification within reason, right? So, whenever you do diversification, remember that you want to pay attention to the underlying correlations. Because if things really, really get bad enough, and say Ian is right, and, things, get to a point where we do see a meaningful drawdown, it doesn't matter how diversified you are if the correlation risk is still fairly heavy, right? And usually when you incorporate 44 securities within the same portfolio, chances are more than a few of them are positively correlated to each other. So you're not actually benefiting that much from diversification. In this case, it feels like it's just diversification means buying more. It's not necessarily the case. It's diversification truly means that the securities that make up your portfolio aren't correlated as strongly, and what that means is that the overall volatility of the portfolio goes down, right? So that's one thing that I would say with respect to diversification. Now, is this time really all that different? I mean, that's another popular phrase that we've heard in our business for a long time now. And what I'll say is that it's always dangerous to say that, at this point, given the risks that we think people are overblowing it. AI is not a bubble, so we should be fine and not all that diversified. I think the diversification is the right approach here, given the fact that we've had several years of strong returns and everything is insanely concentrated right now and valuations are relatively high. So whether or not this time is different or this time is not different, the fact that we're taking a bit of a different approach from years past, given the things that we mentioned earlier, I think is prudent.
Yeah. Okay, so his heart's in the right place.
Right.
The execution maybe leaves a little bit to be desired. Okay.
Good point.
Appreciate you playing along with our hot takes. Those are great perspective there. Our live viewer Q&A is coming up in just a few minutes. So if you haven't got your questions in, make sure you do. But first, I want to bring in my colleague, Caitlin Cormier, because she's going to show us how to research equal weight ETFs in WebBroker. Caitlin, welcome to the program. I know you have to dig into WebBroker to find this one for us, so much appreciated. Let's get right into it. How can investors screen for equal weight ETFs and other index funds, frankly, on WebBroker? Show us how it's done.
Yeah, it's a little tricky. It's definitely a niche area. So we had to do a little bit of digging to kind of get to those equal weights. But let's go ahead and jump right into the platform. And one of the easiest ways that I found is just coming into research under investments and clicking on ETFs. Now, depending on what you're looking for, you can switch between Canada and US here at the top. Just for the purposes of today, I'm going to go ahead and choose the US side, and then I'm going to choose the category of US stock. Now, once I'm here, I've gone ahead and clicked large blend. I know I'm going down a couple of rabbit holes here, but if you look on the right-hand side of the screen, you can see that there are a number of ETFs that are going to show up here that are index S&P 500 specific. And you'll see even, for example, right here, the third option on the list is indicating that it is an equal weight ETF. Now, there isn't any easy way to see within WebBroker what is an equal weight and what isn't. So you do have to do some legwork of your own. Of course, this one right here says it right within the name, which makes it a bit easier. But you do need to dive a bit deeper to understand which ones are equal weight and which ones are market weight. But once you've found some of these different names, you can come up to your watch list here. And I have one ready, so we can actually add. So we'll do the equal weight one, for example, and then I can also add the other one that we saw right there. I don't know, we can do, any other ETFs, and we can add them kind of side by side and create a watch list so that we can kind of track those individual companies moving forward, prices, and sort of have a listing of these securities all in one spot.
Okay, so once you do the treasure hunt and you do the digging, you got a short list there that you can kind of do. Let's say you're looking forward to making a buying decision. How do you compare and contrast these different funds to ultimately help yourself make a decision?
Yeah, absolutely. So performance can be one way for us to sort of get a bit of a gauge between different securities. It can be tricky because they can have different prices, right? We're looking at, they're all issued at different times, so the actual individual unit price can be different. So let's look at a fun comparison here. So if we come into WebBroker, we can actually, again, within that ETF overview page, so the first page we came to, we can actually indicate here a few different ETFs that we'd like to compare. So again, I'm just going to choose the ones that I had on the previous page here. I can just type in up to 5 different ETFs, and then I can just click compare. And this is going to show me a side-by-side comparison of each one of these ETFs. It'll go into things like when they were issued. It'll talk about the manager, any Morningstar ratings, of course, performance, and it is giving us percentages so that we can understand a little bit better. Of course, we do see there's an outlier. The one in the middle is certainly different performance than the others, which is the equal weighting, which makes sense. We've got some that are and some that aren't. So definitely gives us some contrast there. And also there is the option to choose the performance chart. And again, we can see the two that are kind of on top of each other are the market weight ones, whereas the one that is the outlier there in this case is going to be that equal weighting. So you can really get a good idea of kind of how these maybe perform similarly, but also different when it comes to these types of funds.
Okay, so a nice, easy comparison tool to put things side by side. That's fantastic. We appreciate you showing us the ropes as always, Caitlin. Before we let you go, though, I believe you have a special announcement that you want to share about next week's show. Fill us in. What do you got for us?
Yeah, I'm really excited to actually be the host next week. I'll actually be there live in studio. We have a really exciting International Women's Day episode. So yeah, really looking forward to being there live in person and bringing a great conversation to all of you then.
Of course, fantastic stuff. We look forward to hosting you. I know you're going to break a leg. It's going to be fantastic stuff. So make sure for those watching, you tune in next week as well. Lots of good stuff. Caitlin, appreciate you showing us the ropes as always. That was Caitlin Cormier. She's TD Direct Investing Senior Client Education Instructor. All right, Bipan, the time is upon us. It's Q&A. Let's open the floor. Let's see what people want to know more about.
Sure.
Let's see what's on tap first. I believe this one is coming to us from Paul. Paul wants to know, what's your view on overweighting sectors like utilities, pipelines, banks, or telecoms to reduce AI-related concentration risk in a portfolio? Okay, so a specific AI-related concentration risk that Paul's concerned about. What are your thoughts on this one, Bipan?
Yeah, I like it. I mean, I think utilities and pipelines in this environment, certainly if we're looking at, migrating away from the expansionary phase of the economic backdrop, or the economic cycle, I should say, towards something that's a little bit more slower. I mean, utilities and pipelines in that environment should do well. Pipelines in particular, because it is tied up to the infrastructure story that globally is expected to do very, very well. I think that certainly makes a lot of sense. And, if we're playing the energy theme as well, that's certainly one particular sector that should benefit there. Banks, I think you have to be a little bit more selective given the valuations that we're seeing there. There was this sort of wave of enthusiasm, let's call it, early last year based on the fact that we were going to see regulatory changes in the U.S. that would benefit the financial sector, but we would say that's probably priced in at this point. If we're talking about Canada, I mean, certainly banks are valuation is relatively high, but we're a little bit more optimistic on banks north of the border for the simple fact that they're flush with capital and they're still very good at diversifying the revenue streams, even without the incremental loan growth. So, a great way to hedge AI-related risks there. Another one that I could potentially throw on top of that is healthcare. Healthcare did really well in Q4 of last year when we did see AI, or at least the AI theme, take a bit of a breather.
It seems like the theme that I'm getting here is, defensive might be the positioning that somebody who's concerned about those risks might want to consider.
Yeah, I mean, I think so. Certainly, even if you want to pair a few defensive sectors with something that's a little bit more cyclical, that's still a defensible strategy in this environment, given the fact that, again, fundamentals are still relatively strong. And we're not quite at the point where the economic expansion is at an end. We're still seeing some incremental gains there. But if we were to sort of teeter into something that's a little bit more nefarious, so into, say, a slowdown or even a recession, then we maybe remove the cyclical component of it and just focus on the defensive. But we still think a barbell approach here makes sense.
Right. Yeah. Okay. Great answer. Let's get to our next question. This one coming to us from Yan. Yan is asking, what should investors be aware of as potential downsides to equal weight index funds?
Right. So you are overweighting some of the smaller mid caps in a few indexes, right? So again, if we're at that point of the economic cycle where things are slowing down a little bit, I mean, there could be a fair degree of drag from the small and mid cap composition of those indexes. Now, I would also qualify that with reminding everyone that there is sort of this push towards value at this point, right? And at this point, despite the fact that the macro backdrop might not be as favorable, a lot of those companies are still undervalued relative to, say, the big tech names. So there still could be a fair bit of participation, and certainly small and mid caps have done well over the last couple of months as well.
The thing with value, though, is we've been talking about value coming back for 2-3 years now, and here we are having the same conversation. What is it about now that would make value potentially the better play?
Well, I mean, it's exactly what we've been talking about. It's been the concentration risk in those few names, right? And the fact that, let's say if we're leveling up or we're changing valuation regimes, we can all agree that those few names that have been carrying the index for the last couple of years are overvalued. Well, if that's the case, then, I mean, what about those other smaller mid-cap names that, if we're changing valuation regimes relative to some of those few names, they're undervalued, right? So, I mean, if we look at, factor-wise, what's done well over the last couple of months, I mean, value has crushed it, right? I don't think that's deniable. And again, it's tied to what I just said, but it's also tied to the fact that on a more fundamental level, we're seeing a greater degree of AI adoption outside of the tech and telecom sectors, right? So again, these are themes that, I certainly feel a fair degree of conviction about at this point carrying forward.
Yeah. Okay, great food for thought. Value maybe finally coming back after a long hiatus, let's say, during this bull
Out of the
market.
wilderness, for sure, yeah.
Let's get to Charles's question. Charles has one for us. Besides fees, what should investors look for when evaluating equal weight index funds?
Yeah, I mean, really pay attention to the underlying composition and how these equal weights are constructed. There are equal weight indexes out there that weight each sector equally, but that's not quite the same as, say, weighing each individual component or the security within that index equally. So again, there are different flavors of equal weight that we would advise all of our audience to really do their due diligence on and understand which one is more applicable for what they're trying to achieve with an equal weight strategy.
When might it make sense to consider an equal weight fund that's equal weighting the sectors versus the individual constituents?
Very good question. And I would say, let's say you are a little bit more constructive on small and mids at a particular point, then maybe you want to look at those sectors that, are comprised of equal weight securities as opposed to sectors, let's say. Right? So, if you're at a point where your conviction isn't really all that strong on, say, sectors like real estate, materials, utilities, then you kind of want to focus on the latter point that I just said as opposed to just an equal weight across every sector. And remember that, if we're talking about a diversified index, some sectors will have fewer names relative to other sectors. Are you particularly confident about allocating a greater degree of weight to a fewer set of names? That's concentration in a different way, or expressed differently, I would say.
Right. Okay, that's great perspective. Let's get to a question from Mary. Mary's saying, how much exposure to equal weight ETFs do you think is a good rule of thumb for somebody to have? You talked about it as sort of like a tactical play earlier.
Yeah.
Is there a rule of thumb out there?
Not that I've come across, to be honest with you. I mean, certainly when we're constructing our portfolios, we'll generally look to allocate around, and I'm not saying this is the appropriate one for equal weight. I would probably venture to say equal weight would probably be closer to 5%, or 2 to 3% for a satellite position. But if you are getting something that's a little bit more diversified and not so much concentrated in a sector, anywhere between 5 to 10% of the portfolio, tactically, let's say over the next couple of quarters, I think makes sense for an equal weight.
Okay. Let's say somebody was really pessimistic.
Okay.
Would it make sense to, basically, is there a ceiling to that tactical allocation where it's it really just stops making sense?
Oh, that's a very, very nuanced question, right? So if I'm looking at a total portfolio, right, a total balanced portfolio, generally I like to keep at least 60 to 70% of that within core positions and the balance within tactical positions. And within the tacticals, I don't like to place all my eggs in one basket, right? So I like to have a tactical position in the fixed income sleeve, also a tactical position in the alternatives sleeve as well. So, in terms of a ceiling, I would say, beyond 10%, I think you're playing a little bit with fire if we're talking about tactical positions, right? So, or, maybe up to 15% if you're really, really constructive on equal weight. I think that's probably the limit that I would go.
Okay. That's great food for thought. Serafina has a question for us. Let's get to what she wants to know. Are there equal weight ETFs that equal weight the various sectors but keep market cap weighting within each sector?
Not that I'm aware of, right? And that particular strategy, I think, it would certainly address some of the concentration risk within a sector that I identified earlier. And maybe I am wrong, and maybe there are particular equal weight indexes that do follow that strategy, but I haven't come across them.
Yeah, I can't say I have either. Although that's a very interesting idea, Serafina.
Yep.
Maybe you should get into investment product research and creation here. That's interesting stuff.
Yeah.
Maybe we could throw a covered call on top of it too. Why not? One question I want to ask you kind of goes back to, again, that tactical aspect of things. Again, for a nervous investor who kind of wants to dial back some of the risk, you talked about, how Ian was saying, you want diversification across many different types of securities, not just the diversification amongst the same type of thing.
Right.
Is now the type of time when, greater alternative exposure or fixed income exposure makes sense to pair with something like equal weighting?
Absolutely. I mean, I tend to historically have relied more on fixed income as that diversification instrument. What I'm worried about right now is the fact that if we are going to have an energy price spike, let's say for a sustained period of time, then inflation is going to become a bit of a problem. And as you and I know, whenever inflation is above target for an extended period of time, fixed income isn't really that great of a diversifier because that correlation risk with equities increases. And in fact, that's one of the reasons why I think gold has done so well over the past couple of years is the fact that, in the beginning, in the middle part of the game, gold was a really good diversifier. Now, I mean, the way it was trading earlier this year, it felt like a meme stock more than anything. But alternatives to me are still, that place where you want to look at for diversification. I don't think that's going to go away anytime soon because I do think that we are going to have above target inflation for an extended period of time. Right, so is now the time to look at diversification outside of fixed income and maybe into the alt space? I would say yeah, absolutely.
Okay.
We're certainly overweight in our own portfolio.
So more research for investors to do if they want to kind of take the edge off of that risk.
Yep.
I think we have time for one more question. Let's get to this question from Joyce. Joyce is asking, are there any tax treatments to keep in mind with equal weight ETFs, especially if they're being held in a non-registered account?
Good question. I'm going to defer that to tax experts. At this point, I'm not aware of any sort of differences. But again, please do your own research when it comes to tax treatments and the like.
Right, yeah. Things can get tricky with the non-registered accounts for
Absolutely,
sure.
yeah.
Okay, that's all the time we have for the Q&A. Appreciate you weighing in on all those questions, Bipan. Great stuff. And of course, just sharing your perspective generally on equal weights and the market environment that we find ourselves in. It's nice to know that with equal weight ETFs, there is a product out there that can do at least something to kind of take some of the edge off.
Absolutely, and we're really proud of our new launch. That's ZEQL, which is the BMO MSCI Equal Weight Index ETF, and we'd encourage our audience to take a look if they're interested.
All right, so fire up Webroker, check it out if you're interested. Appreciate you joining us as always, Bipan. And of course, to our audience, make sure you tune in next week. We appreciate you tuning in this time, but again, we teased it earlier. We got successful entrepreneur and lifestyle entrepreneur Lynn Allure. She's going to be joining us with the money lessons that helped her reinvent her financial life and might help you do the same. Caitlin's going to be hosting that one. It's going to be a lot of fun, a lot of informative chat for any of the women out there who want to get started on the path to financial independence. Lynn has got some great tips to share, so make sure you check that out. That's all the time we have for this edition of the show. Before we go, I just want to share a quick PSA about keeping your investing accounts safe.
March is Fraud Prevention Month, and let me tell you, fraud is skyrocketing. In 2024, Canadians reported over $310 million in investment fraud losses. But you don't have to be a statistic. Your first line of defense is your password. Forget the basics, aim for complexity with a mix of letters, numbers, and symbol. Most importantly, never reuse passwords across accounts, especially for your investments. We recommend a fresh update every 3 months. It's a simple habit that keeps your hard-earned money where it belongs, with you.
You can never be too careful. Stay safe out there, everybody. From everyone at Inside Investing, thank you so much for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.